Really strong rally, Mike. Can we continue?
Unlikely, unfortunately. I'm really worried about the divergent weakness in copper. I mean, you have crude oil up 30%. You have the S&P 500 up 30% this year. Copper's just kind of inching up lately. It's being dragged along. If we just get a little mean reversion in those other markets, copper's got a problem. The key issue is PMI, global's PMI, China PMI, it really subdued. You have to just expect it to completely reverse right away, and I don't think that's going to happen. So to me, copper's stuck in a range, and the bias, I'm still fearful, is down.
Well, let's talk about that, because if you take a look at, say, copper versus PMI, for China, what is the correlation? How specific is it?
It's very high. If you look back the last 20 years, it's close to 0.90. I mean, that's a very high R squared. China PMI, and then that's also a key thing about copper, which is unique. It's very highly correlated to the overall commodity market. Typically, it was crude oil, but the last 10 years, copper has been the strongest companion. So I think it's the market looking forward to decarbonization, technology advancing, and copper should do well in that space, but crude oil has been kind of pushed to the wayside a little bit.
Good point. Thank you so much, Bloomberg's Mike McGlone. Now we want to turn to oil. Now, Tina, commodity forecasters are looking for muted oil prices in the first half, but then really picking up in 2021 and 2022. What do you hear on the street?
I think 2020 is going to be fairly muted. We're not expecting any huge fireworks at this point. And basically what the market is waiting to see is how much the OPEC production quotas will actually help drain down some of the excess inventory that we've seen that's sort of built up and then obviously caused some depressed prices this year. And then we're looking at sort of the second half of 2020 might be slightly more exciting as we see those inventories drain down and the potential for a little bit more action in the price.
On the flip side, if you take a look at, say, CCRV, which is the curve function on the Bloomberg, you can just see longer term depressed prices. Citi just had a note out that talked about how a lot of hedging happened when you saw the back end kind of rally. Is this a good predictor of where we're going to go longer term?
Right. I mean, the market is in backwardation now, which is sort of where it should be, ideally. But if you look at this is not obviously a prediction of what prices will be. It's more where they are trading right now for those contracts. So what the graph is reflecting is obviously the sort of near-term concerns about both supply and demand. And then if you go further out, sort of 5 years out, then we're talking about the potential for shale growth in the U.S. to have stalled out and what happens next.
Hence the potential price spike. All right, Tina Davis, thank you very much. Appreciate it. Now I want to get the outlook for agricultural. So here is a note that came from one of the big investment banks. A plausible bullish scenario might allow for $31 to $32 billion of U.S. ag exports to China over the next 12 months. That's up almost 35% from 2017 levels, but well below the White House ask. With us now from Chicago is Isis Almeida. That's the big question. Are we going to see the big boost to prices as China comes in and buys on that phase one trade deal?
I think that's really going to depend on whether China decides to follow market-oriented purchases or not. So far, they've been saying that they are only going to buy from the U.S. if the price is right. So that makes it a challenging ask to get to 40 or 50 billion. And I think, therefore, there's a lot of skepticism out there where people think, 32, 33 is a lot more feasible. So far, we're still waiting to hear from China. There's still tariffs on a lot of different products. So soybeans, for instance, still has tariffs on. How is China going to manage these imports if the tariffs remain on? So it's really a wait and see game. And that's why I think the reaction to phase one deal has been somewhat muted, with prices for most commodities, at least most agricultural commodities, up 1 to 2% only.
In reality, Isis, is there one commodity that's really best positioned to take advantage of that phase one trade deal in the ag space?
Well, I would say hogs. I mean, definitely pork. We know that China has African swine fever, and that has killed 40% of its herd. We know China is the world's largest pork consumer, and it's going to need pork. And I think that's why we've already seen the move that China took to bring down tariffs on pork for next year, so to make it a lot easier. And we also have the Lunar New Year coming up at the end of January, and that's when the Chinese eat a lot of pork, so they need to make sure the supply is there.
Isis, thank you so much. Bloomberg's Isis Almeida. And now I want to welcome Everett Millman, precious metal specialist at Gainesville Coins. No doubt you're going to be talking about gold. So we hit all the other commodity classes. I'm hearing a lot of like $18, $16, $2,000 calls for gold next year. What do you see?
Well, I think everything is moving in a bullish direction, partly because we're seeing signs that we're late in this economic cycle. Debt and leverage are rather high globally. If you look at household debt is at record highs, corporate debt is at all-time highs, and sovereign debt to GDP ratios are fairly elevated. All of that makes gold the kind of stabilizer, that safe haven asset that not only investors, but institutional investors like central banks are turning to because it seems to be late in this economic cycle.
Do you have a sense of the type of investors that are in now and the new type of investors that need to come in to really help support that higher gold price?
It's a good point because hedge funds and central banks have been the main buyers right now, but the retail demand, retail investors, mom and pops, have not really been jumping into gold or any of the precious metals yet. So I think if we see prices elevate back to about $14.90 an ounce, $1,500 an ounce, and there's more interest, that will drive prices higher when that retail demand comes in.
Right, and then on the flip side, do we have price-sensitive physical buyers in China and India at, say, 1,500?
Absolutely. We saw that earlier this summer, that when gold prices were seasonally elevated, usually gold is low during the summer, and it was rather high, obviously, this year. Imports into India almost collapsed, and there was a bit of a substitution effect where silver imports into India were much higher. So that does seem to, we have seen some price elasticity with gold overseas in India and China, and that may reverse if we have some consolidation for the Q1 of next year.
So does that mean that we have a natural cap at around 1,600, or what's it going to take to get to like an $2,000 scenario in your point of view?
Oh, I think that geopolitics is going to loom largely in that respect. Unless we get maybe an escalation in geopolitical tensions or the trade war kind of heats up again, if the deal falls through, that could drive prices higher. But I think you're right that 1,600 is probably a safe cap, and that we'll see gradual growth towards that point next year.
And what about gold stocks? Like, what does that then mean for the underlying equities?
Well, the miners will do well in a high price environment, but we have to keep in mind that new projects in the gold mining industry generally take 5-7 years to get online. So it could be a gradual process. We may not see miners outperform until a little bit further down the road.
Well, and to that question then, we talked a lot about how gold's going to be demand driven. A lot of the move we saw in other commodities has actually been supply driven. What's the supply picture when it comes to gold?
Well, actually, gold is fairly abundant right now. Production has been steady. Every year, it's about 3,000 tons added to the supply, and gold has a very high stock-to-flow ratio. So the existing stockpile of gold really never goes anywhere, unlike other commodities. So I think that means it'll probably be more stable, and it doesn't follow the exact same pattern like we see with copper or silver that get used up by industry very regularly.
Well, fair. So if we see like a 5 to 7 years until you get like a mine to come online, and we have seen consolidation in the space, is there going to be some kind of supply gap though in the middle, or just means the recycling market, for example, is going to pick up pretty well?
You said it perfectly. I think the recycling will kind of step in and take care of that, because that's generally what happens with gold. So much of it trades hands. There really isn't any of it that gets used up or destroyed. So the supply concerns, I think, are something we can kind of ignore for now.